You have been drawing a structure for months. Swing high, swing low, break of structure labels, change of character errors. Your chart looks professional, organized, certain. And you are still losing trades you were completely sure about? That is not about a knowledge problem. That is a perception problem, and they are not the same thing. By the end of this video, you will not just understand market structure, you will understand what structure is actually communicating, why the same break of structure means continuation in one context and a trap in another, and why the traders who draw the most lines understand the least about what price is doing. Stay with me, because what I'm about to show you changes how you see every chart you have ever looked at. I am Bilal, the disciplined trader. Let's get into it. Here is what most traders do. They open a chart, they find the swing high, they find the swing low, they draw lines across them. They label the break of structure here, change of character there, and then they wait for price to respect their drawing. But price does not respect drawing. Price does not know your lines exist. What price is doing constantly, mechanically, without emotion, is solving an execution problem. Institutions need liquidity to move large position. They need counterparties. They need participation. And the most reliable place to find that participation is exactly where retail traders have clustered their decision. Above the high, where breakout traders enter, below the low, where stop losses sit, and the obvious level where everyone is watching. Structure is not a map you draw over price. Structure is the evidence of price leaves behind after institutions have already done what they needed to do. And the moment you understand that, everything you thought you knew about reading a chart begins to change. I used to sit at a screen for 14 hours at a time on accounts where every pip matters because every pip was money I could not afford to lose. The anxiety was building into something I could not name yet. I was drawing labels on chart I barely understood, defending positions I had no business holding, and watching the same sequence repeat. The direction right, the execution wrong, session after session. I went back through 6 months of those trades expecting to find the mistake, wrong entries, misread pattern, bad timing. What I found instead was that the structure was telling me correctly almost every time. The direction was right, the execution was wrong because I was reading the shape, drawing it, labeling it, defending it, without understanding what behavior produced it. That realization cost me more than I want to say, and it was the reason this video exists. Here is what almost every market structure video teaches you. Break of structure means continuation. Change of character means reversal. That is the kindergarten version, and it is costing you money every single session. Traders believe a level breaking means the move is real. Operator understand that a level breaking often means liquidity is being collected, and the real move begins after the collection is complete. Think about what that means practically. You see price break or swing high aggressively. Volume spikes, momentum feels real. Every single you have been taught to trust is firing simultaneously. So you enter. And price immediately reverses. You do not have a strategy problem. You have a reading problem. You were watching the shapes, you were not reading the intent. A break of structure is not confirmation. A break of structure is information. And information only means something when you understand the context it arrived in. A break of structure after accumulation, after absorption, after displacement from discount, that is institutional expansion, that is continuation. A break of structure into premium liquidity with weakening displacement, with exhaustion underneath it, that is an exit, that is institutional offloading inventory into your confidence. Same shape, completely different meaning. This is why drawing a structure was never the skill, reading a structure, understanding what behavior produced it, and why that is the skill. In a moment, I am going to show you exactly what this look like on a real chart. The full sequence, liquidity graphs, displacement, mitigation, expansion, and I'm going to show you the movement most traders enter and exactly why that movement is the trap. But first you need to understand the difference between two structures running on your chart simultaneously, because confusing them is where most traders lose their directional clarity entirely. Every chart you look at has two structures running at the same time: external structure and internal structure. External structure is the road, the major swing highs and lows that defines where the market is actually going. Higher highs, higher lows, that is the dominant direction. Lower highs, lower lows, the market is moving the other direction. This is the structure that determines the trend. This is what institutions are building toward. Internal structure is the lens inside that road. The small structure that forms within each major swing, the mini break of structure, the internal change of character, the micro pullback. This is where entries are refined. This is also where most retail traders get destroyed. Here is the rule that changes everything. Only external structure determines trend. Internal structure is noise unless it aligns with what the external structure is already doing. Let me make that physical. The 4-hour time frame shows a clear higher high, higher low sequence. External structure is bullish. You drop to the 5-minute chart and you see a small bearish change of character from on a pullback. Retail sees a reversal, retail goes short. Smart money sees a pullback inside a bullish campaign. Smart money waits. The 1-minute chart showed internal rotation. The 4-hour chart showed the road had not changed direction. The trader who reacted to the lane while ignoring the road just entered a trap that the market engineered deliberately. Now, break of structure and change of character. Most traders memorize these as patterns. Break of structure equal highs bullish continuation. Change of character equal reversal. That is the label, that is not the meaning. A real break of structure means one thing institutionally. The dominant campaign successfully defended inventory and expanded auction control. It means continuation is being accepted. It means the side is control, had enough participation, enough displacement, enough commitment to move price beyond the previous boundary and hold it there. The key word is hold. A wick breaking a level is not a break of structure. You know this feeling? Price breaks the level you have been watching. Your heart rate increasing slightly. The candle chooses beyond it. Every part of your analysis says this is real. And somewhere underneath that certainty, so quiet you almost miss it, is a small voice asking whether the follow through will come. Most traders silence that voice with position size. The operator listen to it because that quiet uncertainty is often the nervous system detection what the chart has not yet confirmed. That acceptance has not arrived. A candle body closing and repricing beyond a level and being accepted there, that is a structural shift. That is the market communicating that the previous value is no longer valid. A change of character tells you something different. A change of character tells you that continuation is being questioned, not that the trend has reverse, not that you should flip your buys immediately, that the previous side lost short-term control and opposing participation appeared with enough force to interrupt the flow. Most change of character events are noise, internal rotation, liquidity engineering, temporary rebalancing, designed specifically to trigger reversal trader and trap breakout traders simultaneously. A meaning change of character arrives counter displacement. It shows opposing aggression. It happens after liquidity has been completed. It occurs at higher time frame objectives. It holds against the previous flow. Information has arrived, but information alone does not tell you to trade. Context does. Now I want to show you the complete sequence, the one that plays out on every time frame, in every market, on every session. Most traders recognize this sequence visually. Almost nobody understands it mechanically, and that gap between recognizing and understanding is exactly where the losses lie. Picture this on a chart. There is a clear level above price and obvious swing high. Every trader watching this market can see it. Breakout orders are resting above it. Stop losses from short position are resting above it. The level is public. The level is public. It is known, it is predictable. That predictability is exactly why it becomes a target. Price begins pushing upward, momentum builds, volume increases, the move looks convincing. Retail traders begin entering breakout position, the high break, and then within one or two candles, price reverses violently. Retail is confused. The breakout failed, the strategy did not work, the level did not hold, but nothing failed. Everything worked exactly as designed. What just happened was not a breakout. It was a liquidity grab. Price moved into a predictable zone above those obvious highs. To access the resting order concentrated there. Stop losses triggered, breakout entries filled, participation was engineered, and then came the displacement. Not upward, downward, aggressive, urgent, imbalanced. The kind of displacement that does not drift, it commits. Large candles, killer directional efficiency, the opposing side was absorbed and price repriced away from the previous value zone rapidly. Now price pulls back. It returned towards the area where the displacement originated, towards the imbalance that was left behind during the aggressive move. This is the mitigation. Retail traders who missed the initial move now see an opportunity. They enter as price return to what looks like support. Some of them are right, most of them are early or in a failed mitigation that continues lower. The difference between the ones who read it correctly and the ones who goized this. The retail traders who understood the sequence, who saw the liquidity grab, recognized the displacement quality, confirmed the acceptance. They were not reacting to the pullback, they were waiting for it. They understood the campaign logic before it played out. They were not watching the shape, they were reading the story. Structure was never something you draw, it was always something you read. And the difference between those two things is the difference between guessing and understanding. The trader who draws a structure is asking, what pattern is this? The operator who reads a structure is asking, what objective is being achieved through this behavior? That single shift in the question changes everything downstream. Because when you ask that pattern, this is you are looking for confirmation. You are looking for the chart to match something you already believe. And confirmation seeking is the most dangerous state a trader can be in. When you ask what objective is being achieved, you are observing, you are reading campaign behavior, you are interpreting intent, and intent tells you something that patterns never can. Intent tells you what price is doing before the patterns fully form. The trader who reach this level of understanding go through a specific transition. They stop labeling every swing. They stop reacting to every change of character. They stop treating a structure like a system of rules and start treating it like a language. And once a structure become a language, you stop reading words and start reading meaning. They become comfortable with incomplete information. They stop needing certainty before acting. They begin operating in probabilities, asking not is this break of structure or change of character, but what probability increased with the behavioral shift. The chart does not change for these traders, their perception does. And when perception changes, every decision downstream changes with it. The entire change, the patience changes, the risk management changes, the emotional reaction to losses changes. Not because they found a better strategy, because they changed the lens they were using to see the market. 3 mistakes that prevent this from being installed. Mistake 1. Drawing without context. The trader labels every swing high and lows, every break of structure gets marked, every change of character gets an arrow. The chart becomes dense with annotation and every label is technically correct, but labeling without context produces false confidence. The trader knows what each pattern is called, not what behavior produced it, what liquidity is trapped nearby, or what stage of the auction cycle created it. Structure without context is a map with no terrain. Mistake 2. Reacting to its internal structure as trend change. The most expensive mistake at this level, higher time frame is bullish, external structure intent, a bearish change of character appears on a lower time frame, aggressive displacement, textbook. The trader flips short. This happens because internal structure can feel more real than external structure. The lower time frame is loud, the higher time frame is quiet, but urgency has never been a measure of in this market. Internal structure exists to engineer exactly this reaction, and the traders who flip on it become the fuel that funds the continuation they were originally aligned with. Mistake 3. Treating break of structure as permission to enter immediately. Once a major structure boundary breaks, most traders feel certainty peaks. The move is confirmed, the window is closing, entry feels urgent. That urgency is a trap. A break of structure confirms the direction, it does not confirm the entry. The market must return to the origin of the displacement before the operator has the position that makes the trade worth taking. Entering at the break is entering at the movement of maximum emotional pressure and maximum distance from the optimal location. Break of structure is permission to prepare, not permission to execute. Here is what I want you to do in your next session. Do not draw a single line, open your chart, watch price move, and instead of labeling what you see, ask one question about everything that moves. Who benefit from this move? Ask it when price breaks a level. Ask it when a reversal appears. Ask it when a structure shifts. Ask it during compression. Ask it during displacement. Who benefits? That question begins to rewire how you see the market, not from the outside, where patterns live, from the inside, where intent lives. Do that for one session, then go back to your charts for this week. Find 3 structure moves you misread. Apply this question to each one. The chart will not look the same because the question you are asking will not be the same. Structure is not geometry. A structure is behavior, and behavior reveals intent. The market has been communicating with you every session. You were just reading the wrong language. Learn to read the behavior, and the structure will never confuse you again. If this is the work you are doing, stay on this channel. I only post when there is something worth teaching.